Before the Nasdaq, before the Russell 2000 and before the S&P 500, investors relied on one barometer to tell them how the overall stock market was doing, the Dow Jones Industrial Average, and it's still the most widely quoted US stock market activity indicator. Investors can invest in it through the SPDR Dow Jones Industrial Average ETF Trust, otherwise known as the DIA. It's one of the most liquid ETFs, which makes it easy to see why it's the most searched blue chip ETF amongst financial pros over the last month on Trackstar, our proprietary stock search database. And given the weak economy and uncertainty in geopolitics, is now the time to invest in DIA. The ETF invests in 30 stocks that make up the Dow Jones Industrial Average, which is considered to be one of the top benchmarks for blue chip stocks. And despite only holding 30 stocks, the ETF is fairly diversified. Healthcare makes up 22% of the stocks in the ETF, followed by IT at 20%. And the top 3 stocks by weight represent approximately 24% of DIA's weighting. The ETF is rebalanced each quarter, and from time to time new stocks enter while others leave. And it's been trading since 1998 and has on average delivered double-digit returns annually for the last 10 years. DIA pays a dividend of $6.27 per share, or an annual yield of 1.97%. It charges a gross expense ratio of 0.16%, which is highly competitive in the ETF space. DIA is the only ETF that tracks the Dow Jones Industrial Average, but you have other options to gain access to blue chips. Some of these include the iShares Dow Jones US ETF, the Invesco Dow Jones Industrial Average Dividend ETF, the Schwab US Dividend Equity ETF, and the iShares Core High Dividend ETF. In terms of dividend yields, DIA underperforms the majority of its peers, but it has outperformed them over the past 5 years in terms of average returns. In our opinion, this is a 7 out of 10 ranking ETF. 2022 has been hard for those investing in high growth stocks. DIA, on the other hand, invests in high quality blue chip stocks. It's down 12% year to date, but that's not as bad as the Nasdaq or the S&P 500. And considering all the macro headwinds, we don't think DIA is a bad investment now. However, as the economic cycles bottom in the next year or two, we'll be more interested in indexes and ETFs with better growth profiles.